For most of us, the financial blueprint we inherit is exhausting. You spend 40 years trading your labor for a paycheck, dutifully pushing a boulder up a hill, trying to stockpile a massive mountain of cash before you finally stop working. And underlying that entire 4-decade grind is a very specific, constant anxiety, the fear that your finite pile of savings will run out before your life does. But the math allows for a completely different approach. You can drastically compress that timeline, front-loading the effort of saving into a much shorter window. The traditional strategy forces you to hoard cash, making time your enemy as inflation eats away at your stockpile. If you restructure the timeline, you can weaponize time as an exponential ally. Let's look at a concrete scenario. Suppose you commit to investing 10,000 rupees every month. You do this consistently for exactly 15 years. And then you stop. You never contribute another rupee. After the 15-year input block, you pivot. For 30 years, you extract 50,000 rupees every month. Linear arithmetic tells a brutal story. Withdrawing 5 times your input for twice the duration should drain the account instantly. Yet, you don't go broke. After 30 years of bleeding the account of 50,000 rupees every month, you actually have 3 crores sitting completely untouched in the bank. Taking out 5 times what you put in for 3 decades should leave you with nothing. How is it mathematically possible to extract that much cash and end up exponentially wealthier than when you started? To understand the mechanics of this, we have to isolate the initial accumulation phase. Those first 15 years of investing 10,000 rupees every single month is what sets this entire system into motion. This area chart tracks your portfolio's value over time. It starts slow, then bends upward, peaking at 50 lakhs rupees by year 15. The heavy lifting isn't coming from your pocket. A massive portion is the silent, underlying exponential growth compounding in the background. And that brings us to the exact moment you hit year 15. Your active labor and financial sacrifice come to a complete, permanent halt. You are not trying to save your entire retirement fund during this window. You are strictly building a critical mass of capital that has enough gravity to achieve its own independent momentum. At this point, you introduce a systematic withdrawal plan, or SWP. This is the financial mechanism used to pivot a portfolio from the building phase directly into the harvesting phase. This tank represents your 50 lakh principal. As you take your $50,000 out each month, the remaining balance continues to compound. Crucially, the interest generated on the total balance is larger than the $50,000 being removed. Think of it like skimming the foam off the top of a constantly rising liquid. You take the surface layer, while the core volume beneath remains completely untouched and keeps expanding. Because compounding is highly sensitive, if you drop your withdrawal to 40,000 rupees a month instead, the underlying base expands even faster. Over a 30-year timeline, that slight reduction in withdrawal leaves you with 4 crores instead of 3 crores. There is no trick to this outcome. You are simply crossing a mathematical threshold where the rate of exponential growth permanently outpaces the rate of linear subtraction. When you step away from the charts and apply this equation to a human lifespan, the implications shift entirely. People often assume that achieving extreme wealth requires an exceptionally high salary or working relentlessly until age 65 to secure enough cash. The math proves otherwise. Wealth generation is actually about giving exponential curves the runway they need to scale properly. By front-loading your effort while you have the energy to actively earn and save, you engineer a scenario where your capital is forced to work much harder than you do as you get older. In the final calculation, the sheer amount of money you invest matters far less than the amount of time you let it sit undisturbed. Time, not capital, is the ultimate currency. Building a financial well that never runs dry requires buying into the math and putting the system to work as early as possible.